Hey, the stock market was actually up today. Dow up 72 points, NASDAQ up 34 points. What a change from yesterday when there was a big downward move in the market. In fact, when you look at the Dow for the year, down 7% so far this year.
It's rough. It's been rough.
Investors a little nervous about this. Certified financial planner Doug Flynn is with us on the line. His firm, Flynn, Zito Capital Management. Hi, Doug.
Hi, Pat. How are you today?
I'm well.
So, Doug, is this a correction or the end of the bull market? What are we looking at?
I don't think it's the end of the bull market. I mean, it could be a slight correction. After the last couple of years, we've had the markets up from the lows of 2009, about 160%. We've had the longest month after month upward movement without a 10% correction just about ever. So it would be very normal to have a 10% correction, but I don't even know if we're going to get 10.
Mm-hmm.
It's so funny because the market has a way of hurting as many people as possible, meaning that you might see it go down 9.5%, and just when everybody thinks they're going to buy, when it goes down 10%, you never get quite that 10%, and it starts to rally back. Maybe today was the turnaround already. We don't know.
So, Doug, anybody in your position who's managing money on behalf of people has the nervous client where they're looking at something like this. They're, wow, I made great money last year. Maybe this is the market's sign to me that I should be cashing out. How do you address those concerns here for somebody with a long-term perspective?
I think a lot of this gets down to rebalancing your portfolio. Just as a quick example, if the beginning of 2013, if you had 70% in stocks, by the end of the year, even though you thought you started at 70%, you ended up at 80% because the stock portion of your portfolio went up so much. One of the things that you should continually do, and January is a good time to do that, is rebalance it. If 70% is your normal number, or 60 or 50, you take those opportunities to shift back to your original allocation. And what that allows you to do is take some money off the top of the market that ran and buy into the things that went down. And so what you would have done is right now it would have been taking some money off of stocks and adding it into the bond market, which seems counter. A lot of people don't necessarily want to add to bonds, but it's a balancing mechanism that sort of helps you never get so far away from where you really should be. And that's how you not worry about the day-to-day or the month-to-month.
Doug, there's been some weak economic data recently. There's been a weak jobs report and manufacturing data that came out. But yet some people are saying the weather may have played a part in that. The argument being, for instance, if you're looking to buy a car, you're not going to want to tiptoe around some new car lot or test drive a car when it's 4 degrees out. Is that for real, or is that an excuse for the downturn or correction that we've been seeing?
I think after the run you've had, we are looking for excuses for it to sell off, and that presents an opportunity for people that are still in cash or who've never gotten back in. They're waiting for that correction everyone keeps talking about. And there is some seasonality to the numbers, and weather does play a part. But we have to almost disconnect the economy from the market. The market trades on fundamentals and how profitable a company is, and we're talking about record profits on the companies on Wall Street. And so you might not necessarily think your situation or certain areas of the economy are doing well, but when you look at the companies and their earnings and their profitability, that's how you gauge how to make money and whether or not those are overvalued or undervalued. And even though the market has run up a lot, it is more fairly valued, but it is not overvalued. So these sell-offs are opportunities that we still have room to run before we get to an overvalued scenario like we do at various points.
So it's a contradictory almost, because you hear about people out of work who can't find work, who don't have a good prospect for work, but if you're at one of these companies that's going great guns, it's not an issue to them.
That's right, and I always talk about the different hats we wear. If you put on your employee hat and you get fired or let go, it is absolutely devastating. It hurts your personal economy, and you think everything is not going well. But let's say what you got laid off from was, you ever see what happens to a stock when they announce layoffs?
Yeah, it goes up.
That's right.
Right.
And so
because the company's lowering costs.
That's right. So you put your investor hat on and you say, you know what, I might be losing over here, but I'm making over here. Or every time you fill up at the pump and you say, oh, my God, I'm spending $4 a gallon, it's going to cost me $100 to fill up my SUV. It's a lot of money. And then you think, but wait a second, inside my 401k and my mutual funds are Exxon and all these other companies. I'm making money over here. But the problem is not everyone is part of the investor class, and that's what we have to try
All right.
to do.
Doug Flynn, thank you so much. I won't panic yet. Doug Flynn of Flynn Zito Capital Management. Thank you.
Thank you.
Pat Kiernan, The Ride Home, exclusively on 77 WABC, where New York comes to talk.